Welcome back. We're now joined by Manish Jain, the head of fund management, PMS and equity advisory at Centrum. Manish, thank you very much for speaking with CNBC TV18. I think this is the first time we're chatting now on the channel.
Yes, that's absolutely right. Thanks for having me.
Okay, great. Look forward to more conversations. But let's start with your overall construct on the markets now. We've had a fabulous run-up. There are concerns about valuation. Stock picking has become a lot more difficult, but there is high interest in equity. Equity is the place to be. So what's the advice in terms of money management now?
Yeah. No, I would stay invested in the markets. Now, if you look at it from a 12-month time frame perspective, obviously 2023 has been a fantastic year for equities. Everybody's made money. The small caps and mid caps have done phenomenally well. But if you look at the broader markets over a 2-year basis, right? So Sensex has basically since January of 2022 to now, on a CAGR basis, has not really outrun the earnings growth yet, right? So it's been just about a 10-11% sort of a compounded rally. And if you believe Nifty is going to deliver somewhere close to 960, 970 rupees of EPS in this current financial year, and then about 1,050, 1,070 in the next financial year, then on a broad-based basis, on a one-year forward basis, Nifty is still looking at around 20 to 21 times on a one-year forward basis, despite trading at close to 22,000 levels. So my sense over here is that this has been a sort of a surprise bull rally which has happened. But it's here to continue. I'm going to be still very constructive on the market because earnings growth is holding up. If you look at this current quarter also, the early trends that have come in, I think people have been positively surprised with the kind of results the IT sector has delivered. Margin expansion has come through. So broadly strong earnings growth, fundamentals of the economy being in place, inflation has cooled off. Political stability looks like it's here for some time to stay. I think everything coming together, I would, from a 3-year perspective, still continue to remain invested in the market. Any correction, if at all, that may happen, I would use that as an opportunity to kind of top up my equity investments.
This equity performance, the results that we've seen and the kind of rally that's followed thereafter, is the optimism misplaced? Because the extent of the beat wasn't significant. It's not that the IT companies came out with a blowout performance. It's just that it wasn't as bad as what this street was fearing. And we've seen the stock reaction to that to the extent of about 10%. So where do you stand on the equity IT stock performance and even the fundamental performance? And how do you marry the two?
Yeah, no, there has been a little bit of a disconnect, and it's not just in this quarter. If you look at the last couple of years, when the earnings growth was stable, that was a time when these stocks were actually all falling like 9 pins. And last year, when the results actually started going bad, these stocks have been rallying all through. I think the connect is more holistic. It's more macro. It's more forward-looking view that you are taking. The market is kind of taking on these stocks rather than looking at this current results. Clearly, the margin pressure seems to be now going away. We are witnessing, these companies recalibrating their workforces. The attrition rates are kind of stabilizing. The utilization levels are kind of going up. And the general view is that the rate hike cycle in US will well and truly over. And this is the calendar year where you should see the rate cut cycle coming through. So if you look at the 4 big banks results right in the US and you try and reconcile that with the IT sector, I think the optimism stems more from a perspective of the 2024-25, earnings growth outlook than anything else. So I would still kind of continue to remain constructive. I think if you look at the large cap space, especially in the IT, I think valuations still remain very, very compelling as compared to the last 3 or 4 year average.
Okay. If you had to put in money on corrections, which would be how would you allocate your portfolio?
Yeah. So that's a very, very good question. My approach would be more bottom up than top down. But having said that, my sectoral bias would still kind of remain towards auto, towards pharma, discretionary consumption, and banks in that order, right? So that's a space where I'm going to be looking at. But ideation is not going to be dependent on whether it's a large cap, mid cap, or a small cap. I'm going to be agnostic to that, and I'm going to look at more of a bottom-up approach because the rally, what I've seen in the last 12 months, has not really been very, very uniform across different companies in the same sector, also across market capitalization. So there are still pockets of value which exist when you look at BFSI, when you look at pharma, chemicals, autos. And that's the approach I would be taking. And every correction, I would just stick to quality, I would stick to these names, and I would still just keep topping them up.
In autos, because that's clearly your preferred bet now, we've had 2 good years on the run. What's the bottom-up approach? Just zero in on autos.
So autos is a very simple story of premiumization, which is starting to happen, right? If you look at the four-wheeler space, the way Indian consumer is thinking and the way he's buying has changed dramatically in the last 4 or 5 years. The entry-level car definition has moved from what was about 3 to 5 lakhs earlier to now closer to 8 to 10 lakhs, and that's where the entry-level affordable SUVs are coming into play over there. So that's the premiumization trend we are witnessing over there. Some of these companies have done phenomenally well as far as the EV trend is concerned. Now, it may not be very substantial as far as the overall contribution to earnings and bottom line and top line is concerned, but it's a trend, right, which you have to catch. You have to be an early rider in the bandwagon. And similarly, if you look at the four-wheelers, the two-wheeler space again over there, the premiumization trend seems to be playing out absolutely perfectly. And the good thing about autos as an industry is that for a very long time, we've had massive macro headwinds in the sector. It could have been the BS6 implementation, the change in insurance norms, right? All of that kind of played out for a very long period of time. But now is a time when the sector is starting to play out in its own merit. Urban consumption, especially discretionary consumption, leveraged consumption seems to be doing really, really well. And that's a trend that the sector is kind of riding on. Prefer two-wheelers over four-wheelers, but wherever we see the early EV trends playing out, premiumization trends playing out, those are going to be the names where I'm going to be sticking, my bet on.
Okay, didn't get time to ask you why you've not mentioned the PSU defense, the PSU power plays, but that's going to be for another conversation, Manish. We're out of time right now. Thank you very much for joining in. We'll get into a break on the other